Hello traders, this is Frank Paul from Forex Mentor speaking with you on Saturday, March 2nd, 2013. Welcome to our latest weekend complimentary video presentation walking you through COT analysis and how it can help you with your trading. What I'd like to do is focus our attention here on recent calls with regard to the Euro-Yen pair. And we'll specifically go back to Friday last, that is February 22nd, to see what we had to say in our report, which is now archived. We're not making this up after the fact. We're showing you what we said ahead of time, what the implications were, what the outcome was, focusing on Euro-Yen. So what I'd like to do is begin with not this, but rather this. And sorry, the view is a little awkward here, trying to fit everything in on a single screen. But that is the title page for our COT MarketWatch weekly COT wrap-up report. You can see it consists of short paragraph long entries on major currencies, forex cross pairs, commodities, and equity indexes, a total of 28 markets that we track every week. Of course, cross pairs are not generally covered by the CFTC's own reporting. We have a simple but innovative approach to aggregating the underlying futures data for two individual currencies, netting out to an implied position for the cross pairs, which proves to be very, very accurate over time, just as accurate as it is for the currency majors, etc. So we only include written commentary like this, verbiage, if there is something really interesting happening, and if not, we don't bother. Just to save you time, we're not going to put in a paragraph entry that says, gee, there's nothing much going on with the COT data and the chart analysis this week, so don't worry. We'll only focus on the charts that are of particular interest here. Now, it's a little awkward because the commentary for Euro-Yen splits over 2 pages. And I'll just read it for you here. This is what we had to say as of Friday, February 22nd, just in case you can't see the type font's a little fine here. But I'm quoting myself. Commercial traders added slightly to their net short bias this week on the implied positioning for this cross pair, resulting in the second most extreme bearish divergence for the entire 18-month look-back period. Last week, we suggested that a daily bar close below the February 8th swing point low at 123.43 would constitute the proof we needed that a daily chart downtrend is underway. That event occurred Thursday this week. Look for that broken support to hold as resistance as we seek rally sell opportunities for the foreseeable future. See chart extract 3 below. Okay, let's go to chart extract 3. This is what we posted in our report. And you can see evidence of a topping process here. Going back to early February, a lot of congestion initially, but we had drawn a dashed green line underneath the February 8th swing point low at 123.43. That was in our chart annotation actually the week prior. And so price bounced around. There wasn't that great a sort of a longer term short opportunity that announced itself. But when we said that once price had broken this level, that's it. This thing is heading down, at least for the foreseeable future. And that event had already occurred on Wednesday the week prior. Or sorry, this would be Thursday. Okay, so Thursday, February 28th, if I'm recalling correctly here. Sorry, excuse my messy dates. I might be off a day or two on calling the date stamp here, but the point is, we said there was a specific support level. We said that if it was broken to the downside on a daily bar, close below 123.43, look out, because that's the confirmation signal we were anticipating. And so we had that strong down bar close. We'll find the exact date stamp there in just a minute when we look at the chart. And then a slight up close below that, but still the damage was done. That resistance was broken. So we suggested that rallies into the foreseeable future should be sold. We're selling the rallies in a downtrend. That's what we had to say, and I hope that was fairly clear. Okay, so what I'd like to do now is also show you the COT file for the euro-yen pair. Again, as it appeared last week. And if I could just find full screen mode. There we go. Now it's too small. Boy, oh boy, I just bungle my way through this technology left, right, and center. Let's try that again. Okay, we'll just leave it at that sort of unelegant view there. For our members, Friday last week, the latest COT reporting date, which is always Tuesday, we can only update as early as Friday afternoon. So that was Tuesday, February 19th. So we can see that commercial traders were still very net short on the euro. Our color coding here is obviously red for bearish, green for bullish. And it's always a symmetrical reading. So if commercial traders are net short the euro, 26,298 contracts, that means everybody else on the opposite side of the market is long by exactly that much, still chasing that uptrend, even though the commercial traders are fading the move. We had talked about that. We had suggested weeks prior that commercial traders were fading the up move on the euro. Still bearish into February 19th. Not an extreme bullish reading for that week on the yen. Well, relatively it was, but not to the extremes of 90% or higher on the index ranking. That had most recently been achieved January 29th. But it's kind of the perfect storm here that we're looking for to result in weakness for euro-yen. Euro weakness combined with recent yen strength, what's that going to do to the cross pair? Well, obviously it's going to result in an extremely bearish bias. So it's the aggregation of the commercial traders net short, net long positioning for the two currencies, which combines for an implied position on the cross pair. Just this past week I received a suggestion, or a query I should say, from one of our members saying, well, why don't you convert the contract quantities into value? Reflecting the different valuations, unit values of an individual futures contract, which will be X dollars for the euro, Y dollars for the yen, etc. And it's a good point. However, I can't do that in a meaningful or specifically accurate way because I don't know what the valid exchange rate would be to undertake that valuation, given the fact that futures contracts have various different dates attached to them. I don't know. I can't just sort of say today's exchange rate applies for all the aggregate futures contract volumes here. So we don't try to get fancy in that way. I suppose we could try, but I don't know that it would add any value. From what I've seen, just looking at pure volumes like this, irrespective of the underlying valuations, still results in perfectly valid readings, as we've seen over the past couple of weeks, calling a top on euro-yen. Indeed, pretty much all the yen quote pairs, which have since weakened, even dollar-yen. Okay, so when we come to February 19th, we can see an index ranking on the aggregation of commercial traders, euro positions, yen positions, 2% index ranking. That is just behind the week of February 5th and just behind the week of January 29th. But aside from that, the third, I guess I should say, the third, not the second, the third most bearish reading of the entire 18-month look-back period here. Okay, and so this is just a PDF version. Of all 28 markets that we track, we provide both an Excel version with charts and a PDF version. So we have 2 pages of tabular data and then another couple pages, 3 pages of charts, for example, Euro-Yen commercial versus spec net positions, and net positions index for both sides of the currency pair and the pairing itself. Okay, so it was a very clear, unambiguous call that we had been making for some time, looking to confirm that downtrend reading. And pardon me while I get rid of my cursor crosshairs here, it's a little irritating to look at. Okay, so let me get the correct date stamp here. Again, we said that once this particular low was broken, February 8th, and that happened on the 21st. There we go. And so there was that lower close, and then on the 22nd, it seems as though we got just a small little retracement. Now here was the real interesting thing that happened. Look at this massive gap up open. I don't remember the last time I've seen something like this in the forex market. We had a close on Friday, February 22nd at 123.23. We had a huge gap up to Monday's open at 125.10. Really unusual. Okay, but that should not have been read as strength because the trend has already been confirmed down on this break of support in the aftermath of weeks and weeks worth of COT signals saying, whoops, this thing is finished, the uptrend since October. And there you go, big down close on Monday. I mean, that was the full extent of it for this week, but what does this look like even seen on the daily chart? It's now a confirmed swing point low for Monday. There's a little spinning top, kind of a rejection wick low, a hammer, another spinny top. These little daily bars do not indicate a viable uptrend. They indicate corrective action, so that when we drill down to the 4-hour chart, we can see very clearly what's going on. Okay, so there's the big gap up. There's Friday's close, there's Monday's open, and then immediately price makes lows. Retested that Monday high, but there's just no way you can look at that gap up and say, oh, strength, particularly given the fact that not too many hours later it made a very clear swing point high. The markets, as you know, usually rush to fill in a gap, and that's exactly what they did here. So huge collapse. Now, realistically, would you have grabbed that move? Well, if you're trading Monday open, Sunday afternoon, evening in North America time, you would have had to be pretty lucky to catch that. Realistically, it's been a very sluggish, tepid, tedious, barely scalpable corrective process since. But that's how we have to read this. The daily bars suggest corrective action. Look at all these dojis and spinning tops. Hardly a progression of Heikin Ashi shaved bottoms. Not much of an uptrend reading on the moving average either. I could change this very easily to a zigzag to give a clearer, more linear look. I like to use a reading of 0.5. So I'll just render the moving average invisible. And the zigzag does a really nice job outlining what I thought I saw with my own naked eye, which is that we have a clear, sharp, sudden impulse wave, but off of that rejection wick low for 8 p.m. on the 25th, we have one wave up, little pullback against it. We're in a second wave up now. That's a zigzag correction, a three-wave corrective pattern, and I suspect that by early next week we will see a swing point high on the 4-hour chart, and then this zigzag indicator should start to point us lower, which would be a pretty reliable indicator that that corrective process is finished and we're now ready for the next leg down. This is just such a short, sharp, huge down move. It's unsustainable in the immediate aftermath. We need to let the market achieve some kind of equilibrium, catch its breath, take another breath in before it exhales and heads lower. But that's totally what we're expecting here. Market flow is indisputably bearish on the 4-hour chart. There's no way we can call the move up from 118.74. An uptrend, it's an up move, but it's corrective in form and function, not indicative of a return to yen weakness, i.e. an uptrend for any of the yen quote pairs, including this one, euro-yen. Corrective action up from 118.74 should top out, head lower in a big downtrend continuation move next week. Okay, so this is all an update pertaining to action over the past week. This isn't new or sudden. We had been calling a downtrend for at least a week prior, and in fact we had been fishing for a top for some time. Price was admittedly stuck in a very hard to navigate channel here for a while, but we suggested at the very least there's no way this is still a healthy uptrend. And given the COT readings, which had been bearish for weeks prior, we suggested that the eventual break should be not in the upwards direction, but downwards. And that's how you marry together basic market flow, market structure, support resistance analysis together with COT signals. And of course, in our foundation course and our introductory PDF manual, we kind of walk you through our suggested approach for all of those things. That's not what I wanted to do. Keep forgetting what my cursor is up to. Anyway, that's our look at euro-yen for today. I'm quite sure that if you follow us for at least a month, 4 weeks worth of weekly updates, our weekly COT wrap-up PDF report, our data files, tables, and charts, you should get a pretty good handle on what's going on in terms of the big picture trend, and I'm quite certain that can help you if you're taking a medium to long-term view on the market. If you have any questions or comments about today's review, please feel free to contact me anytime via frank@forexmentor.com. Would be glad to hear from you and answer your questions. With that, thanks for joining us today. Enjoy the rest of your weekend. We'll talk to you again really soon. Bye for now.